What's good everybody and welcome to today's new video, where in this one we're going over the ICT 1 minute entry model and the ICT 1 minute entry strategy you can use to be able to pass funded accounts and actually get better entries that don't get stopped out. Now, I just want to say before we dive into the strategy itself, if you are new here, please do like and subscribe, as 81% of you who watch my videos are not yet subscribed. So if you are enjoying the content, please do subscribe and drop likes and comments. I will be responding to any comments you leave below. Now, I should say that this entry model has some tweaks to the 2022 model that I've implemented myself. So whilst trading the 2022 model, if you are not familiar with, it is on ICT's YouTube in the 2022 mentorship. Whilst trading this model, I found a few flaws that don't work personally for me, and so I've made some tweaks to it which I will go over in this presentation here for you. Now, getting started here with the framework of this. So the framework of the model is that we need to follow order flow, we need to wait for a retracement to discount or premium, and then we trade into an hourly FVG and target the high that's left on the retracement towards the hourly FVG. So if you take this example here, you can see we leave a low which sweeps liquidity. We then move higher and higher, and that's our highest high. So we take the range from here to here, and that, which I've marked out for you, is 50% of the range. Or in other words, this portion from here down to here is our discount, and this portion from here to up here is our premium. Now, as you all know, we want to be buying in a discount when bullish. And you can see here on this retracement, we come into a discount, and you should notice a familiar 3-candle formation here, where from the low of this candle to the high of this first candle, we have a clear trade through and a gap in between. This is on the hourly chart, and this gives us our hourly fair value gap. Now, once we have this framework set and it is all valid and you've ticked off all of these checkpoints, following order flow, which means that we are moving up and in a bullish scenario, then we retrace to a discount when we're buying, and then the hourly FVG needs to be traded into. Of course, this becomes our target where the external range liquidity lies, because we've traded into internal liquidity with this retracement, and now we target this external liquidity up here. Now, we will drop down into the model itself and the entry technique to be able to find an entry within this fair value gap here. So on to the execution and the most important part about this model that I'm going to be teaching you today. Now, once we've traded into the hourly fair value gap, so let's say we have an hourly gap here in a premium because we're looking to go short, we're following order flow and we're checking off all the checkboxes that I had on the previous slide. Now, once we trade into our hourly FVG, we wait for a liquidity grab of the high or low that forms. Now, in this scenario, we trade up into the fair value gap. We have a leg lower, which notice how it doesn't break any swing low inside here. A swing low is a candle that has a low and then 2 higher lows next to it. This low is equal to this low, so that is an hour swing low, and we don't have enough momentum downwards anyway. Because of this, some of you may be going short down here when you've seen this happen, thinking that's a swing low when it isn't, and we haven't got enough momentum to. So what do? We wait for a liquidity grab inside the hourly FVG that we traded into, which we get here. We come upwards and take out the liquidity above this high. As you all know, everyone who's gone short down here has their stop loss above this high, and everyone who is trying to long the breakout as we trade above has buy stops above here. So we know there's lots of liquidity that rests above the high. We wait for a liquidity grab, and then we get our shift lower below this swing low. Why is this our swing low? Because we have a high here and then a high here, and then we move much lower, breaking past this low. We then notice how we leave a fair value gap within this. So after we break the swing low, after taking the liquidity out of the high that formed when we came into the fair value gap, we then wait for this momentum to happen and to break the low here, which gives us our shift in market structure, as you can see on our second checklist. We then look inside the leg that gave us the shift and look for any fair value gap, which is of course known as the 2022 model. As you can see here, between these three candles, we have a gap inside here. The next candle trades up into the gap, creates a swing high, and then moves lower towards our liquidity down here and this order block. Now, this one simple trick that you wait for to get an entry can change your trading and can improve your win rate massively. When I implemented this, I implemented this a while back now, where you wait for a liquidity grab when you're already inside your point of interest or hourly fair value gap in this case. On the 1 minute chart, we wait for this to happen and then we break lower, leaving our gap, which gives us our entry. Now on the next slide, we're going to dive into an example again, where I'll break down a full trade and how you would actually find the entry inside this one. So as you can see here, we are on the hourly chart of AUD USD. And you can see that we have a low, we trade up in towards this candle and then this rejection block here. That's not the important bit. The important bit is we take out sell side liquidity, move higher, and then trade into a fair value gap after the break in market structure. Now, this looks like the entry technique pattern, and it actually is, but on the 60-minute chart. You could take this trade with your stop loss below here and actually just target the highs up there. However, I like to drop down to the 1 minute chart to wait for the liquidity sweep inside here, which is the part that increases the win rate even more. So, dropping down into the 1 minute chart. Now, this is all time distortion and accumulation. As price is moving about inside this range, we are accumulating shorters as we're dipping down here and more longers as we're going up there. And people are going short at these points with trailing stop losses all below these highs. People who've gone short up here have their stop losses above all these highs, right? So this is our accumulation inside the gap. We then wait for our sweep on sell side liquidity, and notice that happens here. We have a low put in, we move about and consolidate, price sweeps the low, taking out the early buyers there, moves up, and then goes into a gap inside here, which isn't where our focus is. Our focus happens when displacement comes into the market. Now the displacement happens here with this heavy move up, and now we take the swing low to the swing high that created that movement and then measure out a 50% level. Remember, we want to be longing in a discount and shorting in a premium. As in this case, we are of course longing, and on a 1 minute chart, we look for any gaps inside this price leg below the 50% level. Now you can see inside here, the first gap below that 50% level that we see, that is where your buy limit would be placed. So when our range is created, look below the level. Do you see a gap inside here? Nope. So your eyes go to the next one. Do you see a gap inside here? Yes. That is the nearest gap. There's also a gap here and a balanced price range, but price doesn't need to come into this gap because we're already in this one and it's in a discount. So we take the first gap. Price may leg down, but it shouldn't go below this low. Okay, notice how we also sweep some sell side liquidity here before moving up. That's even more confirmation. Now we've had our sweep and our sweep down here. Buy off there with your stop loss below this candle's low. And then you can see that that target is actually this external range high on the 1 hour. Now that is a massive risk to reward. That's about a 1 to 4 if you put a buy limit there, stop loss below here, and then target up here. Notice how just waiting for one liquidity sweep can massively increase the win rate, and the logic behind that is that the sellers are into the market with the liquidity sweep, and then the early buyers get taken out of the market because their stop loss is below this low. So just implementing this one little thing can completely change your trading, and you can pass funded account challenges with this. Now, that brings us to the end of the video and to the end of this model. I hope you did take notes and actually learn something from this. If you did, please do drop a like and a comment. I will get back to as many comments as possible. Subscribe if you're new, as we post 2 times a week over here and have been for quite a while. We're trying to be consistent all winter. So please subscribe if you are not subscribed. As I said, 81% of you watch the videos but are not yet subscribed. So just hit that subscribe button And yeah, I hope you enjoyed the video and learned something. There's plenty more where that came from. There's loads of content on my channel already, and we will be dropping all winter. So yeah, thank you for watching, and I'll catch you in the next one.